Hey, Dan Passarelli here. How you feeling today? All right. We got a great class today. Today we're going to be talking about maximizing profits from trending stocks with options. Before we get started, I need to point out options are not for everyone. You should read characteristics and risks of standardized options before trading, and you can get a copy of that by emailing investor services at theocc.com. Don't trade with money you're not prepared to lose. And everything we're talking about today is generalized information, not specific to your specific situation. Now, for those of you who don't know me, my name's Dan Passarelli, but I always like to double check and make sure that you can hear me and you can find the Q&A box. So would you please head on over to the Q&A box and give me a big woohoo if you can hear me. Make your way on over to the Q&A box and give me that big woozy hoozy. All right. Please do that. That'll let me know that you can hear me. That'll let me know you can find the questions box. Maria, all right. Anonymous secret agent man over here. Marie, hey, hi, how are you? Welcome. Okay, that's all wonderful. Oh, yeah. Okay, perfect. Now, allow me to introduce myself. Once again, my name is Dan Passarelli, and I am an author of two of the top option trading books, Trading Option Greeks and The Market Taker's Edge, and contributed to other books as well that I have some co-credits to and articles, etc. And I'm a trader. Used to trade down in the pits, and they say you can take the trader out of the pits, but you can't take the pits out of the trader. So I still trade every day now in a retail account, just like you. And I am the founder and president of Market Taker Mentoring, which is the global leader in option trader education. And I collaborate with a lot of good people in the trading industry, great options friendly brokerage firms like Firstrade, as well as just about all the exchanges literally in the world. Been at the one, Amex, collaborated with Pico, CBOE, Philly, ICE, Box, the one in Hong Kong, one in Shenzhen, one in Shanghai, all over. And I'm a family man, married to my wife, Kathleen, who those of you who are Market Taker students who take classes with Market Taker are probably familiar with Kathleen. She works with us and runs our operations. And I'm a runner and a foodie and a traveler, been kind of all over the world, whether that's just having fun with my family or friends or through my travels with Market Taker. And I'm a music person as well. Now, I want to give you something today that you can have, that you can keep. And it is some other complimentary classes, both for new option traders as well as experienced option traders. All you have to do is go to our website, markettaker.com, and just go over to the top right and click on Join Free. And that's where you get some other helpful complimentary materials. So today we're going to talk about basically option strategies for trending stocks and how to maximize your profits by using those option strategies. So we're going to talk about analyzing trending stocks, planning your trades, a brief review of options. I know there's some familiar faces here. I don't need to go through a whole explanation of the basics here. In the money call play, debit call spray, not call spray, call play, and Q&A. So the intent of this class is not to teach technical analysis. Presumably, many of you already have technical analysis indicators that work well for you. And I have found that technical analysis is very personal. The ones that I'm going to talk about here happen to be some that I personally follow and provide value to what I do. But my intent today is to discuss the next steps in your trading plan and the one in which most traders run into trouble: implementation. There are a lot of traders out there who are good at technical analysis, but option trades that are destined to fail because they overlook important details of the option trade itself end up causing problems. Many times these traders call the market right, but still lose money because they made an option trade that wasn't set up properly. Sometimes these trades are buoyed by time of day, sometimes the volatility component of the option, sometimes time decay, sometimes just choosing the wrong delta. So we're going to talk about a lot of these things. Now, as far as finding trending stocks and momentum stocks, the kind of things we're talking about today, there's a lot of ways you can find them. We can look at certain stock patterns that we can actually scan for. Like we did a class about a month ago, about 5 weeks ago, on the red knockout and the green knockout. Remember that? Hopefully you saw that. If not, go back through the Firstrade archives and make sure you take a look at that. The red knockout and the green knockout are very specific patterns, and there are other patterns too, just simply trend lines and, triangles and wedges and that kind of thing. Some people will use volume indicators. But there are also some preferred indicators that I think are very, very helpful. One, of course, are the moving averages. Specifically, where a stock crosses up above a moving average, or down below for that matter, if we're playing it to the bearish side. Or where a shorter term moving average crosses above or below a longer term moving average. These can indicate momentum as well. Trend lines I mentioned, when I look at pure support and resistance, I look at horizontal lines, but trend lines are more connecting lows, basically higher lows, as well as higher highs. And we get a channel that kind of goes up, and we have trend lines at the top and the bottom of those channels that run parallel to each other. ADX, the average directional index, combined with DMI, those can be very valuable in determining, ADX in determining the strength of a trend, and DMI as to the direction and strength of the trend. The relative strength index is a personal favorite of mine. I like to use that, especially looking for divergences. I find those to be a more powerful indicator. And, whatever it is that works for you. Again, we're here today to talk about how to make sure once you identify a momentum play or a breakout play or directional play, that you do it the right way using options. Does anyone want to share some technical indicators or chart patterns that you use for your momentum plays? I've talked to some of you that use the red knockout and or the green knockout, but go ahead and hit that questions box for me. I'd be interested to hear some of the things that you use. Maria says the MACD. Yes, the MACD, which is related to what I talked about moving average crossovers. Very, 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 very good. That stands for moving average crossover and divergence. Okay. Well, let's talk about planning your trades. Let's discuss the all-important planning process. So this is what I have found to be a very, very useful way to make any trade. I call it the MTM trading path. And it consists of these steps: observing the market, basically finding trade ideas and discovering the opportunity, but then analyzing the technicals, analyzing the news, analyzing the volatility, stating the forecast, selecting the strategy, and planning our exits, and then implementing the trade itself, monitoring the position, adjusting if necessary, and then finally exiting the trade. Now, today, we're going to talk a lot about these steps right here. Analyze or discovering opportunities and analyzing the technicals. We're going to talk about those a lot, but we're also going to talk about selecting the strategy. And then we're going to talk about planning the exits. All right. So I know, like, I recognize a lot of the names in here. I know that many of you have attended our classes here with Firstrade, my classes here with Firstrade, and you know options. And I recognize, and there's some names that I don't recognize. So I'm going to give you just the world's fastest crash course in what options are. So if you already know options, hang on for about 1 minute and 37 seconds. And pay attention anyway, because you still might learn something. So a call is the right to buy an underlying asset at a specific price called the strike price in a given time constraint. For equity options, stock options, that means you can exercise at any time between now and expiration. So that's one type of option. There's only two types. The second and only other type that are listed on exchanges anyway is the put option, which is the right to sell underlying assets at a specific price, a strike price, within a given time constraint between now and expiration. So basically, you buy a call because you have the right to buy it at a fixed price. The higher the stock goes, the more valuable the right is to buy it at that fixed price. With the put, you have the right to sell it at a fixed price. So the lower the stock goes, the more valuable the right is to sell at that higher fixed price. Buy a call, you want the stock to go up. Buy a put, you want the stock to go down. But we don't just buy options, you can buy them or sell them. And that's really important to talk about. If I buy a call, I have the right to buy the stock. If I buy a put, I have the right to sell the stock, not obligation. I can choose to exercise it. If it's in the money, meaning for a call, the stock price is higher than the strike price, so there's some intrinsic real value there, I would naturally exercise it, regardless what I paid for it. Even if I lose money, I'd lose less if I exercise it. And a put, if the stock's lower than the strike price. But it's also common for traders to sell options as well. And when I say sell options, I don't mean, okay, I buy the call and then later I sell it. I mean, I have no position and I sell it short. If I sell an option, I have an obligation. I have an obligation to sell the stock. If I sell a put, I have the obligation to buy a stock. And if you think about it, it's just because these options are contracts, and contracts have certain rights for parties in the contract. Person who buys the call, or has the right to buy the stock, but who's he or she buying it from? Well, you're buying it from somebody who sold that call. So when he buys a put, has the right to sell the stock. Who are you going to sell the stock to? Like, stock exists. There's shares that exist for real. So there's got to be a person or business that you're selling it to. Well, that's the person or business that sold the put. So those are what we call outrights: buy a call, buy a put, or sell a call or sell a put. But it's also very common to trade spreads. Spreads are combining two or more legs or components. So I might buy one call and then sell a different call. Each call in that spread, that two-part trade, we call a leg. And they're used to shape the risk. And by that, I mean, well, I'm going to give you some examples throughout this class here today. But by shaping risk, what I mean is making my risk reward more optimal. Okay? Because remember, when it comes to option trading, I can make money on, well, let's get ahead and then come back here for a second, on the underlying price going up or down, direction, which is measured by delta. I can make or lose money by time passing, time decay, because options lose value as time passes. That's called theta. And or I can make or lose money by implied volatility changing, which is measured by vega. So that's what I mean by shaping risk. Just this idea of making a trade where, you know, maybe I lose less if it goes against me and I make more if it goes in my direction. Or maybe I make a trade where I have less exposure to time decay. Excuse me. Or less exposure or more exposure to implied volatility, you know, because maybe I have an opinion on it. So there's lots and lots of different alternatives to basically massage my delta, theta, or vega to do it in such a way where it's most beneficial to me. Doesn't that sound kind of exciting? Like, doesn't that sound like a pretty powerful tool to have in your toolbox to be able to make trades that are better for you than how a typical person might make a trade? So when we talk about breakout plays, there are a lot of people who talk about the in the money call trend play. And it can be a superior trade to an at the money call where the stock price is about the same as the strike price. And basically all the trades that I'm going to talk about here are trades for the upside, trades for stocks that are going up. And so we're going to just talk about calls, but we could have the same conversation about puts. All right, so let me just jump right in here and start talking about this in the money call trend play. Why trade in the money calls? And again, that's where the stock is already higher than the strike price. I might own this right to buy the stock at 70 and the stock is trading at 75. So I already have $5 of value that I could just exercise the call, buy it at 70 and turn right around and sell it at 75. That's called intrinsic value, and it means the call is in the money. So the objective of the in the money call is to capitalize on a trend with leveraged directional exposure. But with any outright option trade, again, outright, just buying a call, not part of a spread, there are some hurdles. The main hurdles are time decay and volatility. We know that when we buy options, as time passes, the option gets worth a little bit less, right? And, you know, if I think a stock is going higher, I naturally want to buy a call to make money on that direction, which is measured by delta. But I have time decay working against me, which is measured by theta. So I have these things that are kind of butting heads a little bit. And then there's volatility, which we did a class on here with Firstrade. We did it on Tuesday, November 12th. And we did some workshops on it even earlier. Volatility, specifically implied volatility, is really, really important when it comes to option trading. And so we want to keep that in mind. Now, we're not going to focus too much on it today, but I'm going to just kind of weave it into our conversation because it is important. So, okay, we got this thing that we want, directional exposure, although if it goes against us, we want as little as possible. But then, because if we're using options, we've got time decay working against us, and we have volatility that could work for us or against us. Now, usually when stocks go up, the implied volatility goes down. So implied volatility usually works against us when we're buying calls. Because if we're right, we make money on direction, but we lose money on theta and volatility. So in the money options, they have less exposure to time. Well, I mean, here, actually, before we even get to in the money options, let's talk about just buying shares of the stock. If I buy, and we'll back up a slide here. If I buy 100 shares of $100 stock, cost me $10,000. Now, what's the worst that can happen? Well, the stock can fall to zero. Has that ever happened to you? Probably not, but looking at the number of people in here, there's a chance that it did happen to a handful of people here. This is something that literally actually does happen time to time. Now, normally, it's a slower process, and you do have the opportunity to get out of the stock, but sometimes it happens fast and violently. Notably, the example that everyone loves to talk about is Enron, right? You might have had a little bit of time to get out of there, but you know, that's hard to do also. A lot of people think, well, I bought this stock because I liked it. Now it's lower. There was a little bit of bad news, but oh, it'll come back, right? So, like, this is one reason why we buy calls, because instead of spending $10,000 on 100 shares of $100 stock, we might spend $300 by buying one call on $100 stock. So options are going to get us more limited risk. So the in the money options, they have less exposure to time decay and volatility than the at the money options. Okay. And they have a higher delta than at the money or out of the money options for that reason, or for that, for that matter. And so a higher delta means we get more of what we want. We get more of that directional exposure. If the stock does go up, that we think is going to go up, we make more with a higher delta. And if it goes up, or if it doesn't go up, or if it goes down, we lose less if there's less time decay and less volatility than at the monies. So the in the money, just a straight in the money option outright purchase can be very valuable. Can be. So let's say a trader thinks that this stock will rise sharply from its current value of around $137.90 over the next 3 weeks. So here's what we can do. We can buy an in the money call, in this case, the 125 strike calls. Remember, at the money is 137.90. So like basically we'd be talking about like the 138 call or something. We're going to buy one where we already have the right to buy it significantly lower than where it's trading. It's trading at 137.90. We have the right to buy it at 120. Now, why are we doing that? Well, first of all, from a leverage standpoint, it's way better than just going out and buying the stock, right? Because if the stock is $137.90, we'd have to pay $13,790 for 100 shares. Or I could buy one call for $1,570. The actual offer here is $15.80, but a lot of times we can middle the markets a little bit, buying a little bit above the exact middle price, which here would be like what, 162 and a half or something. But you know, above the middle price, but still below the offer. This one we could probably get filled at about 1570. Okay, so let's explore here, right? What's my exposure when I buy a call? Well, direction. I can only lose $1,500 instead of $13,000. But if it goes up a ton, I can make a ton, and I've got the in the money calls move in step quite a bit with the stock, which is another way of saying it has a high delta. We do have time decay, which works against us, but it's lower for in the money options, as we'll see in a second, and same with volatility. So direction is the thing we really want. Now, we have to go back a little bit here. And we have to talk a little bit about our good friend delta. Delta is the rate of change of an option's price compared with the underlying asset. In this case, the stock. So that means like if the stock goes up by $1, the call goes up by the amount of the delta. If the stock goes down by $1, it goes down by the amount of the delta. So here, if we're talking about these December 27th, 125 calls, maybe we buy a 10 lot of these, pay $15.70 each on a per share basis. The delta of this is going to be something like 0.85. That's 85%. So that means this call is going to move 85% of the amount that the stock moves. Stock goes up $1, call goes up 85 cents. Stock goes up $2, call goes up $1.70. And then we lessen the effects of time decay and volatility. So time decay, the rate of time decay is measured by theta. Theta is the rate of change of an option's price as time moves forward. If the theta is like 0.07, that's 7 cents of option premium. As each 1 day passes, all else held constant, the option loses 7 cents. And so if I own options, in this case a call, it doesn't matter if it's call or put when it comes to theta. If I own them, I lose based on time decay or theta. Can I make money on theta? Is there a way to make money on theta? Sure there is. What if I sell an option? You know, I mean, time doesn't move backwards. It only moves forward. Options always get worth less. But if I'm short an option, it benefits me for it to get worth less. I make money. But so far, for this example, we're just simply talking about buying a call. Now, vega is the rate of change of an option's price, value really, compared with the change in volatility, specifically implied volatility. So again, esoteric, implied volatility is an esoteric concept. But go back and review the class we did on it on Tuesday, November 12th. It's archived on the Firstrade website somewhere. So let's say we buy 10 of the December 27th, 125 calls at $15.70. So we know it has an 85% delta, moves 85% like the underlying stock does. It has a theta of 0.06 and it has a vega of 0.09. So that means as every day passes, these calls lose 6 cents. And if implied volatility goes up, these calls make 9 cents. If implied volatility goes down, they lose 9 cents. Okay, so scenario one, the stock rises $1 today. Okay, now our original time horizon was like 3 weeks. But if it rises $1 just today, well, that means no time passes and volatility may or may not change. Right now, we're going to assume implied volatility doesn't change just to make it easy. And so how much would we make? Well, let's first revisit this yellow box and revisit how much was the call price originally. We bought it at $15.70. Stock went up $1. And so the option or the call increases by 85% of $1, so 85 cents. So that's 1570 plus 85. It would be worth 1655. We'd make 85 cents. Now, one day did not pass. That move happened today. So I don't lose anything on theta. We're assuming implied volatility stayed unchanged. So I didn't make or lose anything on vega. This is pretty straightforward. And also, by the way, I want to point out here, you may or may not have access to all these Greeks, and that's okay. If you can get access to the Greeks, that's even better. You can be a little more scientific about it. But bare minimum, I want you to understand the concepts we're talking about today. All right. Even if you just understand the concepts and don't use the exact values, you're still going to be a better trader for it. Okay, so this is scenario one. It goes up $1 today. Okay, but what if it goes up $1 over a 7-day period? And consequently, volatility, implied volatility, falls 1 point. Okay, well, then what happens? Now we just went from like a one-dimensional thing to a three-dimensional thing. Okay, we went from tic-tac-toe to solving a Rubik's Cube. But once you understand the tools and the methodology, it's really not that hard to solve that Rubik's Cube we call option trading, or the Greeks. So if the stock rises $1 over a 7-day period and volatility falls 1 point, we're basically looking at the exact same thing conceptually, but just some different numbers. The call would actually be worth $16.05. Why? Well, all we really need to do is look at the Greeks. If it went up $1 and the delta is 85 cents, it'll go up from 1570 plus 85 is, well, whatever the price was just a minute ago when we talked about it. See, yeah, whatever was, what was it? It was, hold on a second here. I just want to see something. 1655. Hold on 1 second here. 1655. Okay. Oops. So on the other one, we made 1665. Or the other one, we made 85 cents. It was worth 1655. But on this one, we made less. So how do we get to that? We still make that 85 cents because the stock still went up $1, but 7 days passed. So that's 6 cents of theta, as you see in this yellow box, times 7 days is 42 cents. So I made 85 cents, lost 42 cents on, made 85 cents on delta, lost 42 cents on theta. What about Vega? Well, implied volatility falls 1 point. So I lose 9 cents on Vega. So make 85 cents, lose 42 cents, lose 9 cents. There's a little bit of rounding here. We assume this trades in nickels. So it ends up being worth 1605. I only made 25 cents this time around. Now, if you're having a hard time wrapping your head around the comparison here, let's put them side by side for a second. The in the money call. Oh, let's put side by side an in the money call versus an at the money call. So the in the money call, even though we only made 25 cents, I mean, still, that's something, right? What we would really like to do is see that move happen faster, like in 1 day, before a time decay has time to reap its woes, or maybe rise by more than $1, because we make 85 cents every time the stock goes up $1. And, you know, it's, if I lose 42 cents in theta for a week, if it goes up $1, I only make 85 cents. If it goes up $2, I make $1.70, but still only lose that 42 cents. So I always need a faster or a bigger move when I'm buying calls. But let's go over to the right side of the screen here for a second. Look at the at the money call for a second. With that stock at $1.3790, the at the money call is going to be the closest strike to that price. So the 138 calls. I could have bought those at an original price down at the bottom of the screen here in the yellow box at $6.55. At the same time that I could have bought the in the money calls at $15.70. Now, notably, I'm paying a little less than half the price for the at the money call. So you might think initially, well, that looks more attractive. I can risk just half the money, or I can buy 2 of them and get double leverage. Well, let's look at that first. The thing about at the money calls, again, on the right side of the screen versus in the money calls on the left-hand side of the screen, is that the delta is lower. The delta is 85 on the in the money call, but it's only about 50 on the at the money call. So every $1 the stock goes up on the in the money, I make 85 cents. Every $1 the stock goes up on the at the money, I only make 50 cents. But the theta and Vega are bigger for the at the money call. I only lose 6 cents a day with this in the money one, but I lose about 12 cents a day with the at the money one. I lose twice as much. 7 times 12 is 84 cents. I lose only 42 cents on the in the money call over a week. I lose 84 cents on the at the money call over a week. So I make less on direction and I lose more on theta. Well, what about implied volatility? Well, whenever I buy options, I get positive exposure to implied volatility, meaning if it goes up, I make money. If it goes down, I lose money. But when stocks go up, the implied volatility typically goes down. So the Vega for the in the money call is 9 cents. If it goes down 1 point, I lose 9 cents. But the Vega for the at the money call is bigger. It's 15 cents. So if it goes down a point, I lose 15 cents. So versus the at the money, I make less on the at the money because of delta being smaller. I lose more on theta for the at the money because of theta being bigger. And I lose more on Vega with the at the money because of Vega being bigger. So the in the money call tends to be a much more superior trade to the at the money call, especially if the move happens faster or the move is bigger. Now, anonymous secret agent man here asked a question. The return or loss is total per share or per 100 shares of contract? Good question. So with option premium, I buy one of these calls at $16.55. That's $16.55 per share. So I multiply this times, excuse me 1 second. So I multiply that times 100. So that's $1,655 per contract times 10. It's like 16 grand. But that's because I'm controlling 1,000 shares. Each one contract represents 100 shares times 10. This position represents 1,000 shares. So if the stock is at $137.90, that's $137,900. Like, this is still such a small fraction of what I would pay for the stock. Now, I think anonymous secret agent man is asking about the Greeks. So the delta is just a percentage. I mean, you can look at it as dollars and cents too. It goes, for every dollar the stock goes up, this goes up 85 cents of option premium, but it's really a percentage because stock goes up $1.53. You multiply that times 0.85. But as far as theta goes, that's option premium. It's 42 cents of option premium. So for 1 day, it's 16.55 minus 42. The next day, if the stock doesn't go up or down, volatility doesn't change, only 1 day passes, this would be worth $16.13, 16.55 minus 42. So that's really $42 of money you lose a day. All right. A lot of things to think about there. Very good question too, by the way. I love it. It means you're paying attention. So a couple observations here. Time and volatility are very important. I mean, heck, even the in the money call didn't make a whole ton when the stock went up over a longer period of time. If the stock only goes up a little over a long period of time, it makes a little on delta, loses a lot on theta. But the at the money call, geez, you were right and you still lost money. So time and volatility are very important. So selecting the right strategy can mean the difference between making and losing money. So that brings us to the debit call spread trend play. So why the debit call spread? Well, the objective is to capitalize on a trend with leveraged directional exposure. All right, leveraged directional exposure. But when it comes to options, the hurdles can be time decay or volatility. So the debit call spread kind of gives us a potential solution to minimize some of the hurdles and maximize the directional leverage. Debit call spreads have less exposure to time decay and volatility than just simply buying a call. And by the way, a debit call spread is when I buy a call, and then I sell a higher strike call. Okay. So I'm able to maintain a proportionally high delta and a disproportionately lower theta and vega. So I give up a little bit of delta and I get rid of a lot of theta and vega, which are the problems. So I keep the benefit, get rid of the problems. And debit spreads have a lower capital outlay. Because I'm buying one option and then selling another, the net amount is a lower price. So far, this sounds great. Like this has got to be universally better than just buying a call, right? Well, not necessarily, because we do cap our gains. If the stock, just explodes higher, we only make so much on this trade. So let's explore this. Same idea here. Trader thinks the stock will rise from its current value of around $137.90 over the next, 2-3 weeks or whatever. So here we're going to buy the 130 calls, not the 125. I mean, we could buy the 125 calls, but I'm choosing the 130 calls this time around. They're about $7 or $8 in the money. But then in the same expiration, I'm going to sell the 145 calls that are about $7 or $8 out of the money. 130s are $7 or $8 in the money. 145s are $7 or $8 out of the money. And by the way, one thing I didn't mention before that I should mention is that if I'm planning on this trade taking up to 3 weeks, clearly I need to buy an option that has more than 3 weeks. What I like to do is buy a little bit more time, because in the last week to expiration, that's when time decay really increases. So, in this example, the time I'm doing this, the December 20 calls would have had like something like 23 days to expiration, 24 or 5 days to expiration. I'm buying still one more extra week so that my theta is still lower across the board anyway. But honestly, it doesn't really matter that much when it comes to the debit call spread, because what are the 3 things that I have to think about when I'm making an option trade? Direction, time decay, volatility, delta, theta, vega. So here's how this works. If I buy the December 27th 130 calls at $11, okay, a little cheaper than the 125 calls, buy them at $11, they have a 72 delta, and I lose 9 cents a day on theta, and I have positive exposure of 12 cents of vega. Remember, these are sort of equidistant from where the stock is trading. Each is about $7 or $8 away. So that doesn't affect the delta. Well, it affects the delta in a different way, but the way it affects the theta and the vega is in or out of the money options. The further you go in the money and the further you go out of the money, the smaller your theta and vega. And so we're actually able to just about completely offset them. If at the same time that I buy 10 of the December 27th 130 calls at 11, I sell 10 of the December 27th 145 calls at $3.55, first of all, I'm paying less. I'm paying $7.45. That's less than the 130 call. In fact, that's less than the 125 call we talked about earlier. In fact, it's kind of pretty comparable to the at the money call, to tell you the truth, right? That we talked about. But we're making our delta a little bit smaller. While we're getting long 72 deltas on the 130 call, we're getting shorter 35 deltas on the 145 call. So the Greeks net out. I'm getting positive 37 deltas. Now you might look at this and say, well, that's a much smaller delta than the 85 delta I was getting on the 125 calls. But guess what? My thetas net out too. While I lose 9 cents a day from buying the 130 calls, I make 9 cents a day from selling the 145 calls. My theta on this trade is about 0. You know, there's some rounding here, right? It's fractions of a penny sometimes. But my theta is about 0. Now my Vega, I have positive exposure to Vega when I buy options, so it's positive 12 cents on the 130 calls, but it's negative 12 cents on the 145 calls. So Vega goes down. Sure, I lose 12 cents on the 130 calls, but I make 12 cents on the 145 calls. I break even. I have 0 theta and 0 Vega. So sure, compared to the at the monies or the 125 calls, or even just buying the 130 calls, my delta is smaller, but my theta and Vega are gone. And you know what? Instead of buying 10 calls, I could buy 20 calls, and now I have a big delta again, and my theta still is 0. So an observation here is, again, time and volatility are very, very important. Selecting the right strategy can make all the difference in the strategy's success and failure. Now, that last bullet, let's go back here for a second and look at this. There's a couple of things to think about here. Is this universally better? No, not necessarily. Because if I buy the at the monies or the 125 calls or just the 130 calls, and the stock goes up to, well, 145. Well, no. Let's say the stock goes up to 200. Well, I'm going to make a ton on delta. And it's not even really going to much matter what I lose on theta or Vega. If it goes up to 200, I'm just going to ring the cash register. But with the spread here, while the 130 call gives me the right to buy the stock at 130, which is why you make so much if it goes to 200, the 145 call gives me the obligation to sell that same stock at $1 or at $145. So I buy a 130, sell at 45. The most I can make, well, the most the spread can be worth is 15 bucks. I paid 745 here. 15 minus 745 is 755, right? The best I can do is like 100%, which is, you know, nothing to shake a stick at. I mean, 100%, even if it does take you 3 weeks, is pretty darn good, right? But I would just make so much more if it blasted way above 145, like to 150, 170, 190, 200, if I didn't sell the 145 call. So I cap my upside. Not only that, but if this stock goes from, if there's 3 weeks, if there's 4 weeks or so, 4.5 weeks until expiration, and the stock goes from 137.90 to 145 today, I only make the amount of my delta. It won't be worth the full 15 bucks until we get closer to expiration. So there's a timing component there as well. So moral to the story is, like I said, selecting the right strategy can make all the difference in the strategy's success or failure. If I think the stock is really going to blast higher, well, I want to just buy a call. I don't want to do a spread. If I think the stock is just going to go up to about 145, I'm so much better doing a spread. Well, if I think it's going to go up to 145 today, I'm probably still better off buying a call. If I think the stock's going to make its way up to 145 over the next 3 or 4 weeks, then using the spread is absolutely 100% the best bet. So the whole bottom line here is that using the right strategy does make all the difference, especially when it comes to option trading. You know, you're trading something like red knockout, which I know a lot of you trade, green knockout. We're going to time, and this is in our, our courses on the red knockout and such. Shorter term, buy calls, longer term, buy spreads. All right. Do you have any questions that I can answer for you to help you understand anything a little bit better? Any final questions before we hit the road here? No? All right, folks. Well, that being said, have a great rest of your day, and I will see you next week. We've got a brand new topic to cover, and I can't wait. Thanks for sharing your time with me. Thanks for being loyal viewers and showing up time after time. So I'll see you next week. Oh, Diego asks, are those trades linked? What if one is uncovered and the other is covered? No, these trades are linked. You enter them as a single trade. And you take them off as a single trade too. All right. Have a great rest of your day. Trade smart. Catch you next time. Bye.